everything has kind of been the same. And as of, I would say the last, I'll say a couple days ago on the news, I'm pretty sure everybody knows when they report that the pandemic, the coronavirus is actually spiking, is upticking. And actually, of course, globally, people are starting to pull back and retract some stuff in lieu of the coronavirus spreading. So what has that done? That has equated to stocks going down. Stocks were rising, stocks has been going up, and then now they're down. And what you guys got to understand is that the mortgage, you guys' mortgages, my mortgages, they're all collectively, they're stocking themselves. So they go up and down with the economy as well. It's called it's the MBS. So stocks, mortgages are stocks, and how people buy homes are kind of all gathered together, and they become a stock within themselves. With that being said, that the real mortgage update right now is rates have gone up, and I don't think we're going to go backwards. Hopefully they can kind of retract it just a little bit or stay the same. But I do think the part of what everybody has to know historically is the twos, even the threes, are historical lows. And the way it's going, I'll be honest, I think we've seen the last of that. But I'm not going to go that far. I'm not that much of an economics or economist. But I will say I think that the rates are going up. They have gone up. Last couple of days, they jumped, and I just kind of been hoping that they go back down a little bit. It's not happening, and when that happens, I've seen it before. I've seen it go down. I've watched it go down. I do believe that rates are going to go up, no matter who's elected. And people say, well, Biden and Democrats and stuff like that. Not to get too political, but the proof of the matter is Trump is still in office, and the rates have went up. And they have went up, and I think they're going to go up. So that's the mortgage update. I would honestly, if you guys been out here and kind of to transition into how his business been going, there's been a lot of people who, of course, you guys know that the seller's market has been competitive, and it's pushed a lot of buyers with kind of longer times to find their homes in a way. You know what I'm saying? So I'm still busy because I still have people out here looking, and they still want to buy a home. So as long as you have people out there looking, you're going to be busy. There's needs and stuff. With that being said, the people that I've had, and I've had people since the summertime, their pre-approval now has to be reevaluated. Okay, that's what I'm saying. I'm at a point now where I'm starting to look back at some of my pre-approvals from a month or two ago and saying, you know what, this rate, if rates are going up where they are, we got to talk about it again. So I think we're at that point now. If we get some better news, maybe some stimulus or something where the stocks and everything kind of drops down, I think it's going to help. But again, I think the twos are gone, and I don't want to talk rates too much, you're not supposed to. But I think some of those record lows are they're gonna go away. So
wow, that you answered my question. I was gonna ask, well, do you think it has anything to do with the election, because things get to be uncertain around that time? But you kind of answered that, and made a good point. Well, yeah, the rates have increased, and Trump is still in office. So we've been saying it for a long time, though. Take advantage, take advantage, take advantage. If you're buying, refinance, and do it now. So it has to end at a certain point. So it's important for people to it's still a great time to buy, but to jump on before it really goes up.
And again, I mean, we talk about all the time. If whatever life is, you don't make a decision based solely on race, especially national. If the rate is going to be what it's going to be. If the rate is at 10% or 20%, does that mean that you never buy a home? You know what I'm saying? It's like at some point, still buying a home is a good idea, no matter the climate. Now, there's times in life where things you got to take advantage because it's not going to be what it is. It's a good deal. It's a sale. But when the sale ends, does that mean we stop buying products? No, you still buy stuff. So always, I'm going to promote, for the most part, unless something crazy happens in this new trend. I'm going to promote home buying. And again, we're not talking like, and what I mean, I'm not talking rates. We're not talking sevens or eights or nothing like that. So rates are still relatively low. And it is not just my company. It's not. This is going to be something that I guarantee everyone has experienced because of coronavirus. So I think rates are going back up. We'll see how much, and we'll see if it jumps a little bit. Like I said, I'm still optimistic, and we haven't seen the lowest. I think it's going to maybe, hopefully, go back down just a little bit. But if not, it's still low. 2 years ago, it was what it is now, and people bought homes 2 years ago. So, I mean, really, this is just a flashback of a year and a half ago. So go ahead.
Okay. So, one of the things that I swear I talk about this daily or get questions about it daily is down payment assistance. So, just want to talk to you a little bit about down payment assistance. And first, let me just say this. Some people think it's a little taboo, or they're like, no, down payment assistance, kind of like they have this thought of it that is something bad. And from your standpoint, you think it is something that is bad for someone to use?
Absolutely not. And people must understand. Hey, what's for you is for you. All right, and that don't just apply to mortgage. With your situation is your situation. All right, and I tell anybody that now again, if you have the money, on the long run, you're going to save yourself some money using your funds. Okay, if you're thinking about going a cheap route just because you don't want to pay or use your funds, I understand. Maybe you want to do something with the money or furniture. There's plenty of things that comes up where you just don't want to touch the money, and all of that can be valid. But think twice on the long run. Always, cash is king. If you have the money to put down, you're going to get yourself a better interest rate. Use your own funds and doing it that way. With that being said, sometimes that is not the case, and that's life, and that's okay. If you have the credit score, you need the down payment assistance. If that's the only thing that's going to stop you from getting a home, take advantage. But like I said, I've talked to a lot of people that's on the fence, and that's what happens is sometimes they're like, well, I want down payment assistance because in their head they thought it was some, catastrophic number, and then they're like, well, you know what? I think I can afford that. You know what I'm saying? And we have those conversations. And I tell people, hey, on one side, they give you the money, you need the money, they help you get in a home. On the flip side, if you have the money, you're going to save yourself a significant amount of money doing it yourself. And it's going to show in the long run, no doubt about it. But it's not the end of the world. And so sometimes we start to bring scenarios out with people, and then they start to say, yeah, we could do it ourselves. And if you can, you can. If you can't, that's what down payment assistance is for, and take advantage.
Yeah, definitely is there, for you. So take advantage of it. So from your experience working with people, so when I tell people like down payment, you need down payment money and you need closing costs, right? So number one, a lot of times people don't realize that it's two separate pots of money that they need. So with the clients that you work with, would you say on average, most people have both, or most people have one or the other?
I would say what happens is people have a number in their head. Okay, regardless of what the numbers are, most people have a number in their head of where they could be, where they think they could get, or what they already have. And me personally, my strategy is give me that number and I'll build you a loan based off what you can do. Okay. And then I'll backtrack and I'll think about the down payment and I'll think about the closing costs, and then I'll make it fit to that number. If you tell me what you have, let's just even numbers. You got $5,000. I'll build you a loan, kind of based off the area you at with the taxes, and I'm pretty decent at giving you a round point to understand this is how much money this type of home or this type of down payment will give you. You know what I'm saying? And then I'll talk to them about closing costs and seller credit, which honestly, Andrea, we that's definitely a conversation, is that closing costs. I guess if the second most important thing about my mortgage update, I will say closing costs and seller credit. But just kind of staying here for a second, people have a number in their head. People know, and I want to know that number. I'll be honest, I want to know that number. If you want this house and you're at 5,000, and you know this home and everything included is going to cost you 8 or 9, and you know you're trying to sign a contract right now, and you got 45 days. Sometimes you're not being realistic with yourself to know that you're going to get $3,000 by the end of this loan. We can't do that, no matter how much you want it. You know what I'm saying? So me personally, I start you out with a number, and then I'm going to give you kind of a circle of area of where you can kind of fall into your target number based off the number you give me. If you say, Chris, I could do $5,000, I'm gonna hit you with that number. So to go back to what you said, most people, I guess they know what down payment is. Most people can understand that concept, 3.5% or 5%, and that you have to have some money down. I think the question mark always is how much really is closing costs. And then sometimes they try to add those numbers together or subtract them. They don't know what to do with both numbers. So what I do is tell me what you can do, and I'll figure out both of those numbers.
Right. Okay.
So
that makes sense. That makes sense. So can you touch on that just a little bit? Just share for people that don't know. So FHA, how much do you need down for FHA?
3.5%.
And then conventional?
5% or 3%.
Okay.
If you're a first-time home buyer, and it depends on the area and how much money you actually make, there is an income cap. But if you fall within certain guidelines, you could go conventional and get 3%. So you got 3% or 5% is your standard conventionals, and 3.5% is your standard FHA.
Okay. And what about VA?
VA, no down payment is necessary. Now, of course, you still have closing costs, but VA does not require that you put a down payment down.
Okay. Do you guys at Freedom offer 203K loans?
Yes, we do. 640. 640 is our minimum credit score. Other than that, we got a department, we got a renovation team. We definitely do
them. Okay. Those 203K loans can help a lot of you folks who want to buy any distressed properties that need a lot of work. That's your entry point to be able to do that. You're able to buy the property, get the loan that you need to cover the renovation costs, and then it's one loan from there. So that's definitely good to know.
And as we talk about mortgage updates, especially this time, whatever time it is, it seems like this time of year, 203Ks come in handy, and they kind of uptrend around this time because you're looking for a home. You like this, the area, everything is perfect. You just want to just kind of tweak a few things, and that's when a 203K comes in handy at this anytime really. But especially when inventory starts to get a little thinner, and you have to be a little bit more creative, especially if you know you want to stay in a certain location. How you compromise with yourself as far as what you want and what you have to work with. 203K is that compromise, you know.
Okay. All right. So still on the loans, what are we looking at for a FHA loan credit score wise? What do they need?
600.
600. Okay.
600.
And then what about conventional?
Minimum score is 620. But as you may know, there's a system. Fannie Mae conventional has a automated underwriting system. We all use it. Everybody in the business use some form of it. So for conventional loans, all you do is run the system and then tell us 620. I'll tell you that system is hard to get an approval for conventional at 620. However, that is the rule. So 620 is conventional's minimum score. Usually more like 670-ish,
Mhm.
you start kind of getting more approvals with conventional.
For FHA, are you seeing approvals at 600, or is it usually a lot of times it's like 620-ish?
But yeah, um, yeah, you could get approvals at 600. Here's the thing, okay, when you're talking 6 to 620, and even sometimes after 620, they want the system calls for reserves, so you got to have savings, and so people, but you might come to the table and say, "Hey, all I got is my 5,000. You know, if this loan will cost me 5, I got 5. What's the problem?" And with the lower credit scores, sometimes you need reserves, so you got to have some money set aside. Basically, the system calls for like in the event of something happen. So usually, if you're at 600 or between 6 and 620, you can bank on the fact that you're going to need reserves on top of the money that you have to bring out of your pocket. You still got to show some extra money set aside. So yes, you can get approved at 600, but don't plan on coming with just your funds.
Okay. All right. So I want to run a little scenario by you. So I happen to do something on the side for clients oftentimes, and that's reviewing credit reports. And as reviewing those credit reports, I see something common that comes up. And the client may have had a bankruptcy, which may have been discharged 2 years or longer, right? So that part is good. And then their credit scores are actually really good because they came out of that bankruptcy. So they went ahead and started building credit immediately and added credit cards. So looking at the surface, their credit scores are good, even as high as like 700, we'll say, right? Across the board. So credit scores are good. However, when you look at some of the credit accounts, they have gotten into a situation where they end up overextending themselves too quickly, trying to build, and then they overextend. So now they have these credit cards available, they start using the card. So it's two things that's happening. One of the things that's happening is they have open items that are being disputed. So it shows on the report and it's showing as a dispute on the report. So that's number one. The second thing that's happening are open collection accounts. So, I guess the disputes are collections as well, but they are disputing those items. So if this individual says, I'm ready to buy a house, and they sit in front of you, they have these scores of, we'll just say a 700 credit score, they have open disputes, and they do have some good accounts, like reporting accurate, on time payments and timely payments, but they also have collections sitting out there. When they present themselves in front of you, how would you handle, or obviously without seeing anything, what would you say, or what would happen with this individual?
So, okay. Number one, as you know, disputes is a no-no. You can't actually technically have a few. There's a monetary cap on it as far as how much disputes you can have. So LOs will use that card if we have to, but usually we try to get you. And a lot of places might have you get disputes off completely, whether you're over that $1,000 or not. So the number one is this: if you see the overextension and they're at a 7 and they got disputes, me personally analyzing credit, I know when we pull those disputes off, which we have to, that score is going to drop. It's going to drop. It's going to drop. And most of the time, the borrower knows it. That's why they have it in dispute. My suggestion for that type of person is, okay, I know we can help you. Okay, I know we can help you. However, time frames, man, expectation. You know what I'm saying? You might be ready to go right this second, but I'm saying no. We're going to take a month. We're going to pull these disputes off. We got to pull credit again to say that they're off, and then we're going to kind of take a look at where your credit score is there, and then go from there. You know what I'm saying? That's kind of where, if that person came to me, it's like, all right, let's do the first things first. There are ways to rapid rescore stuff that can expedite that process just a little bit. But me personally, and this is just me, I'm going to hit you twofold. So number one, we're not going to just rescore you to get the disputes off. I know for a fact we got to get those credit cards at least paid down something. You know what I'm saying? So then it starts to have that conversation of your expectations. What do you want? How much do you have for down payment? How much do you have over here? And how much can you give me to work to get this done? You know what I'm saying? Now, if there's money for both, we can expedite that process. But if you need some time or if this money is going to pull into this fund, again, it's not that we can't help you, but let's fix you first, and then we go from there.
Okay. So could a person get a mortgage or be approved for a mortgage if their credit scores are good, they have some accounts being paid, accurate on time, but still have some collections? Would you overlook the collections?
Yeah. No. Here's the thing. Okay, when you're talking 700, a person is going to be thinking, I want to go conventional. Okay. Conventional it's not. It's a little less forgiving on collections. So again, if we run into the system and conventional, doesn't really like it, or it'll tell us, this one has to be addressed or whatever. If that's what it says, then again, we're back to square one, addressing the problem. You know what I'm saying? Now, FHA is a lot more forgiving, and realistically, it's not that big of a deal. You get put in the program that fits you. If you're really kind of more so ready to go now, even with the 7, but knowing you have all that, we're probably going to go FHA. We could probably work and hit the DTI for the collections a little bit, and we can move on. So those are some of the scenarios that people should understand about conventional versus FHA. It's no wrong, right or wrong. If everything is perfect, conventional is the route to go. But if there's some different circumstances, you got to play the systems on which one is better suited for you. So again, disputes, a lot of disputes and some collections, you still may not be able to go conventional even with the 700. With FHA, even if it drops, you're probably still going to land, as long as it doesn't drop too much. You're still going to land in the FHA realm to get approved FHA.
Okay, very, very good. I think most people think like they need a completely clean slate in order to be able to purchase a home. So I wanted to take some time and kind of run through a scenario with you to help people understand what they could be facing. A lot of times people do those disputes just automatically, and they know they owe it. So it's better to just try to settle, go ahead and get those resolved and get them off of there instead of just leaving those disputes out there.
Yeah, and you'll see also, Andrea, you'll see it'll be down the line. As soon as I see disputes down the line, I know you're working on your credit. Mm-hmm. So it's like, if you got a company working on your credit, that's not the same. People gotta understand you shouldn't be doing both of those at the same time. Same thing with a car. You shouldn't be trying to buy, if people do it, a car and a house at the same time.
Synonymous with each other. It's like, get the new home, you gotta get the car. It's like those two words are.
So so again, that's all I say is like, just if you're going to work on your credit, work on your credit. If you got a plan, stick with the plan. You're almost there. See it out, and then sometimes you have credit repair where it's already done. It's not going to go anymore. Let's take those disputes out, and we can keep it going. But you shouldn't be trying to work on your credit and trying to get the house at the same
time. Okay. So how much should someone on average, what's just a good amount for someone to have saved? Like if I know that I want to buy a house next year, 2021 is going to be our year, right? 2020 wasn't necessarily our year, but 2021, right? You want to buy a house. What's a good amount? Like, should they plan at least 5? I know it's the price point of the home kind of dictates that as well, but just a good, is it 5? Is it $10,000? What do you think?
So this is I think is a good transition to the closing cost talk. Now to answer your question, if you're looking for $100,000 to $200,000 home, somewhere in between, you're going to get it done for under $10,000. More than likely under $8,000, honestly. You start going to 2 to 3, then you probably want to prepare yourself for 10 to 12, something like that, 10 to 13. Something, it just kind of depends. We'll stop right there. Now, some of those numbers are considered or taken into consideration closing costs. And over the last year, even before then, closing costs is something that it was automatic. I mean, in some ways, it still is more likely than not that you could get it. However, in realtors, you guys kind of start to set the trend. So, however, now I see realtors out here, and for whatever reason, they're learning that, hey, we got to pull back on the closing costs. That's how we're gonna get you this house, and that's right or wrong. You know what I'm saying? Sometimes it is what it is. They're right. You got to cut the closing costs to get the house. However, it goes back to me and that personal relationship that I have with my clients. Like, I go back to that number that you told me with. No, you know what I'm saying? You told me that you was here, and is it that you're so much into the home that you so want the home now that you're willing to say yes, that's okay, just to get the house? But it's like, dude, our numbers built in maybe $3,000 or $4,000 of closing costs. If you're not taking that, you're coming with that $3,000 or $4,000 that we're not getting. You know what I'm saying? So, and I'm having these conversations with realtors like, hey, also, because we got to work together. I don't want them to blow deals. I don't want you guys to blow deals, but I want us to all close. So if I kind of give you a number, I'm not pulling it out my butt, and it's not that I don't want them to get this house. And I know y'all been out there, y'all tired of looking. So that's what I'm saying. It's you're tired of looking, they're tired of looking. This is it. You know what it takes, but it still doesn't matter if they can complete the deal.
Mm-hmm.
So that's the marriage between the three of us, the borrower, and I'm learning to honestly, I'm learning to appreciate because I'm working more with a lot of the same people, and I appreciate that a lot. You know what I'm saying? Because you start to kind of we got to work together, and so even without new people anyway. But anyway, you got to have that dynamic now because closing costs isn't as guaranteed as it once was. Not offering closing costs is makes your offer more enticing and more competitive, but that's not going to be the model for everybody. If you don't have the money, you ain't got the money. You know what I'm saying? There's nothing wrong with it. And sometimes we have to bring that back down. It's like you want it, your realtor wants it, but I'm looking at it like, dude, do you have it? If you don't have it, you don't have it. And that's okay. No matter what we all want, because I want you to get your house too. I mean, we don't do this for free or by the hour. But the marriage is you got to afford it. My numbers got to work. And a realtor has to get the offer accepted. And that's a delicate balance. So nowadays you see that you might need to save more because you might have to offer no closing costs. Or you might have to compromise with yourself where you find a home that has the closing costs that's thrown in there, and maybe the price is better, but you got to do the 2 or 3K. But these are real life, Andrew, you can contest. This is real life situations that's going on all the time. Realtors, we have to work together because we can't stop them from they got to get the offer accepted, but we still need what we need because we want them to get to the finish line.
Yeah, absolutely. That's just comes with a little experience in that area to be able to know how to write the contract and have the conversation with maybe that listing agent to include those closing costs, in the purchase price of the home, which leads me to my next question. Because with the shortage of inventory and buyers are having to literally write offers $10,000 and $20,000 over the asking price of the house just to make these deals work. And some people are writing 10 and 20 over that amount and still losing out on that property because they're going to a bidding war. So my question is, how have the appraisals been going when they're coming back? So I'm sure you've seen these offers. I don't necessarily know that where it started and where it went because you're just receiving the final contract. But have you seen appraisals come back lower because now price points are inflated?
Yeah. And I've seen one they knocked off. I mean, they're doing it as far as like they knocked off 100. I thought that like the contract was like 190, 100 or something like that, and it was all built in for the closing costs. And the appraiser just like, nah, 190. We're knocking off that. And then you hear these. Here's what I believe happened. All right. So many people were offering over and over and over, and I do believe over time that did for you guys that don't understand is that the appraiser looks at comps and looks at sales in the areas, and so do realtors. So as everybody's offering more for these properties, it's going to take the overall value of homes in that community up. Okay. But what happened last time is people learned to play that so well, it just kept driving up and up and up, and it really wasn't, it was unrealistic. So now appraisers are a little bit more realistic, and I've seen them drop those prices to kind of humble the market a little bit. And I think that's what they're doing, you know. So, but again, it goes back to my closing costs, is because what I believe is that happened quite a bit this summertime. And now what are you going to do? The seller's going to just they're eating it because they're just keeping the deals and going on. So the buyer wins. The buyer offers this outrageous price. They hope, and it happens. They was hoping that the appraiser knocks it back down, and then the buyers actually benefited from that. No problem. I'm on the loan officer. I'm on the buyer side. But now what I think is happening now is instead of inflating for the closing costs, they're trying to get them to not pay closing costs and keep the appraisal value more realistic. You see what I'm saying? And so that's where the balance of it is. Like now, okay, if you got two offers and there's no closing costs, or we're going to give you all the extra money for the closing costs, they're scared that what if the appraisal doesn't happen? I'd rather take it here than take it there. Right. It's an interesting time right now. And I think you're seeing all those things. You can still get closing costs. You can still offer more to get closing costs. But now sometimes you're not going to get that anyway because it's a safer bet to hit their mark on where they think it's going to land and try to get as much of that. Because if it doesn't appraise well, they don't go back on the market. They work with the buyer.
Right. Wow, wow, wow. So you gave us a lot of great information and tips today. So is there anything you want to share with everyone before we get out of here?
As we talked about the rates, hey, if you're thinking about it, what are you waiting on? What you waiting on?
Great.
What you waiting on? Hey, that's all. What you waiting on? Come talk to us.
All right. Well, you heard it. How can they reach out to you?
Always. I'm on Zillow, Christopher I. Hardy, LinkedIn, Christopher Hardy, Facebook, my business page is Christopher I. Hardy, and then it's my end of my last number. IG is call Chris _ the number 4 home loan. So it's call Chris 4 home loan. The underscore is after call Chris. But yeah, if you put in Christopher I. Hardy, Freedom Mortgage, I'm coming up. So talk to me. I love talking to first-time home buyers, but I like talking to seasoned people too, and talk about their options and what they can do. And also shameless plug. I got a thing coming up with Brickhouse where we're going to be talking to investors. So I'm looking forward to that too with CG. So like I said, let's keep it rolling. I love talking about homes. So.
Okay. There was a couple comments on here that I want to mention. One was they said, God is Love 41 said, I'm thinking of moving to Cleveland from Kentucky. I was told it's cheaper, but the crime is higher. Don't do us like that. What can we say? I'm going to say overall, I mean, crime is usually higher when we're talking about inner city. And that's going to be anywhere that you move to. Inner city typically has more higher crime. I would say overall, I feel safe here. I never really not feel safe, at least in the community where I live. So if you're coming here, you just want to make sure that maybe you come visit the area so you kind of learn the area a little bit better. And you really just, they're laughing, you really just don't want to be more so in those higher crime rates. And there's ways that she said she's come from Louisville, Kentucky. So yeah, you probably.
Yeah. I would say here, Cleveland. There, let's be frank. I mean, Cleveland can be and is one of the dangerous cities in the country. I mean, it is. But with that being said, as and I think as Andrea alluded to, I mean, you get that anywhere. If you go to a major city, you got your places you should be at, you know. But on top of that, there's some wonderful, wonderful places, and even in the city of Cleveland, inner city. And I don't know how you guys do it, but the greater Cleveland area doesn't just constitute Cleveland. So there's plenty of places that you can live. But even within the actual city of Cleveland, there's still some good old neighborhoods, man, and there's still some gems. So don't be scared, you know.
Come see me so you won't get stuck in any old neighborhood. That's how we're gonna solve that. And then if, I'm assuming you're a she. I'm sorry if you're not, but can you give me condominium versus single family home pros and cons?
You said condominium versus single home.
Mm-hmm.
So I'm gonna throw an extra one in there. You got condos, you got townhomes, and you got single homes. Okay, and I'm assuming that you're speaking obviously because you know the difference from a finance standpoint. Condos have to be approved. Condos have to you get paperwork from the homeowners association, and we take that, and that paperwork has to get underwrote. So condos take the most likely underwrote part because, like I said, not to get too nerdy, but there's budgets and all kind of stuff that they look at. Single family homes, you're basically worried about the appraisal. Condos is you got the appraisal, but you also got the actual condo how it's like kind of constructed. And is it really a condo or is it just a townhome? So if it's just a townhome, it's not underwrote like a condo. Trust me when I say that. That can confuse either the realtors, even the sellers, even the title, even lenders. There's gray areas of what is actually a condo and what is a townhome. And honestly, sometimes it is a big deal because a townhome is underwrote more like a single family home as there's you don't have to look into the homeowners association budget and all that kind of stuff. So that's the difference. Other than that, obviously the property taxes on the condo is a little cheaper, but you have HOA fees that which sometimes is less, but then sometimes is more. But those are the big differences.
Yeah, it's just understand if you plan on going FHA here in at least in the Cleveland area, there's like very, very, very little amounts of condos that are on the approved list. So it's really hard to go FHA if you were looking for that lower down payment and if you're a first time home buyer. So you can almost plan to go either pay cash or you're going conventional on those as well.
Now, I'll say this, shout out to one of our realtors. We had that happened over us in the summertime, and I was like, nah, they can't do it. They're like, what do you mean? They love this house, whatever, you know. And it's like, and then Winter started doing some things. She's like, you know what? I don't think it's a condo. It's a townhouse. And I'm like, I don't know. And she was right. And we got to write it FHA. That's why I'm saying it, because the person was an FHA person and they could not go conventional. And that realtor figured out that it was a townhouse and we closed it. So again, sometimes you won't even be able to tell the difference between a condo and a townhome just by looking. But as Andrew said, if it's an actual condo and you're trying to go FHA, it's slim pickings. But there's a lot more that I'm finding out that's actually townhouses that's their game on.
Yeah, it's interesting though. Before we get out of here, because I just think so. It's that condo association. They just need to file paperwork and then renew that paperwork. And I always wonder why. I guess nobody cares enough. You know what I'm saying? To just go the extra mile and complete the paperwork. I guess once you're in, you're in. Like forget anybody else that's trying to come in.
It could be so much better. You know, like it's like this little niche that somebody needs to just kind of bring together because they don't know what they're doing.
So, well, thank you for joining and sharing with us. You guys, please go ahead and follow Chris if you're not already doing so. And like the channel as well. Look for those notifications from me when I'm going live. So We'll be back maybe prior to maybe in the next month or so, giving you another update as we wrap up 2020 here. After the election, that probably will be a good one. I'm curious to see what the interest rates will be on the election. So we'll come back, answer some more questions for you guys. So thank you for joining us today.
Thank you.
All right.
Take care.